Ladies and gentlemen, let me start with a simple but powerful question. What if the future is already knocking and most people are still asleep? History doesn't announce itself politely. It moves quietly at first, then suddenly, unmistakably. And today, we are standing at one of those moments. Silver has crossed to 65, and this is not just a price move, it is a message. A message telling us that something much bigger has begun. For decades, silver was seen as the quiet cousin of gold, undervalued, overlooked, and underestimated. But markets don't stay quiet forever. When demand meets innovation, prices don't walk, they leap. And now, a powerful force has entered the equation: artificial intelligence. AI data centers are not just software dreams floating in the cloud, they are physical machines, massive infrastructures, hungry for energy, connectivity, and precision. And at the heart of that system lies silver, the most efficient electrical conductor on Earth. Here's the hook most people miss. AI doesn't run on code alone, it runs on metals. Every server rack, every high-speed connection, every cooling system, and every power relay depends on silver. As AI expands, data centers multiply, and demand for silver accelerates. This isn't speculation, this is infrastructure reality. That is why 65 is not the ceiling, it's the confirmation. The market is signaling that 72 is becoming the new floor, not because of hype, but because of necessity. Think about this: governments can print money, companies can issue shares, but no one can print silver. Supply is limited, mining is complex, and demand is exploding across clean energy, electric vehicles, and now AI. When a finite resource meets infinite innovation, the outcome is inevitable. Prices must adjust upward, and they do so fast when the world finally wakes up. This moment is bigger than silver. It's about understanding where the world is going before the headlines catch up. It's about recognizing that technological revolutions always reward those who prepare early and punish those who wait for certainty. The same way electricity, oil, and the internet reshaped economies, AI is reshaping commodities. Silver is no longer just a precious metal, it is a strategic asset for the digital age. The rapid expansion of AI data centers represents a classic example of a structural demand shock, one that permanently alters the demand curve rather than temporarily shifting it. Unlike short-term investment flows or speculative cycles that fade with changing sentiment, AI-driven demand is embedded in long-lived capital infrastructure. Data centers are not built for months, they are built for decades. Once constructed, they require continuous upgrades, expansion, and maintenance, all of which rely heavily on silver's superior electrical and thermal properties. This means demand does not spike and retreat, it accumulates, compounds, and persists. What makes this moment especially compelling is that AI adoption is not discretionary. Governments, corporations, and entire industries are racing to deploy artificial intelligence to remain competitive. From financial services and healthcare to defense, logistics, and energy management, AI has become an economic necessity rather than a technological luxury. Every incremental advance in AI capability increases computing density, power loads, and connectivity requirements. And as those requirements intensify, so does the consumption of silver per unit of infrastructure. The hidden truth is this: the smarter the machines become, the more metal they quietly consume. This demand shock is also global in nature, which amplifies its economic impact. Data centers are being constructed simultaneously across North America, Europe, the Middle East, and Asia, often supported by state-level incentives and long-term energy contracts. This synchronized expansion removes the possibility of regional demand offsets. When demand rises everywhere at once, prices do not adjust gradually, they reprice decisively. That is why the recent move in silver is not random volatility, but a rational response to a measurable shift in underlying fundamentals. Equally important is the quality of this demand. Industrial demand tied to AI infrastructure is largely price insensitive in the short run. Data center operators do not delay billion-dollar projects because silver prices move higher. They absorb the cost because performance, reliability, and efficiency are non-negotiable. This creates a powerful dynamic where higher prices do not destroy demand, but instead validate the scarcity of the resource. In economic terms, this is where markets send their clearest signal: price becomes the messenger of constraint. The real hook lies in what most market participants underestimate: the time horizon. AI infrastructure is still in its early growth phase, not its maturity. If today's demand has already pushed silver beyond historical thresholds, the implication is profound. Markets are not pricing the peak of this cycle, they are pricing its beginning. And when a structural demand shock meets long-term technological expansion, the repricing process does not reverse easily, it accelerates. Silver occupies a unique position in the global economy because it is not merely a valuable commodity. It is a critical input with physical properties that cannot be replicated at scale. Among all metals, silver has the highest electrical conductivity, the highest thermal conductivity, and exceptional resistance to corrosion. These characteristics are not academic distinctions. They are the foundation upon which modern high-performance systems operate. In environments where speed, efficiency, and reliability are non-negotiable, silver is not a preference, it is a requirement. Nowhere is this more evident than in AI-driven data infrastructure. Advanced processors, high-density server racks, power distribution units, and cooling systems all depend on ultra-efficient electrical pathways. Even microscopic inefficiencies, multiplied across millions of connections, translate into massive energy losses and operational risks. Silver minimizes those losses. This is the silent advantage most people never see. Every millisecond of processing speed, every reduction in heat, and every gain in reliability is underwritten by silver's physical superiority. The more complex the system becomes, the less room there is for substitution. What truly elevates silver's economic importance is the absence of viable alternatives. Copper, aluminum, and emerging composite materials can replace silver only at the cost of performance, durability, or energy efficiency. In consumer electronics, marginal trade-offs may be acceptable. In AI data centers, where uptime is measured in billions of dollars, those trade-offs are unacceptable. When failure is not an option, silver becomes strategically irreplaceable. This is where economics intersects with physics, and physics always wins. The hook lies in understanding how critical inputs behave in advanced economies. When a material is essential, non-substitutable, and embedded deep within capital infrastructure, its demand becomes resilient to price increases. Engineers design systems around silver's properties, and once those designs are standardized, removing silver is no longer a cost-saving decision, it becomes a systemic risk. That is why demand strengthens even as prices rise, reinforcing silver's strategic premium. This reality reshapes how silver should be viewed within economic frameworks. It is no longer simply a commodity influenced by sentiment or monetary cycles. It functions more like a technological enabler, similar to semiconductors or rare earth elements. As AI systems grow more powerful and energy intensive, the value of the materials that make those systems possible rises accordingly. The quiet truth is this: every breakthrough in artificial intelligence tightens silver's grip on the modern economy. Those who recognize silver as a critical input, rather than a tradable metal, understand why its role and its value is fundamentally changing. The emergence of AI data centers as a dominant force in the global economy represents a structural demand shock that fundamentally alters how silver is consumed and valued. Unlike traditional sources of demand that fluctuate with economic cycles, interest rates, or investor sentiment, this demand is anchored in long-term capital formation. Data centers are engineered as permanent assets, requiring extensive upfront investment and continuous operational input over decades. Once these facilities are deployed, their demand for silver becomes embedded, recurring, and largely irreversible. This is not a temporary surge, it is a redefinition of baseline demand. What makes this shift especially powerful is the speed at which it is unfolding. Technological adoption typically moves faster than supply chains can adjust, and silver is no exception. AI infrastructure is scaling at a pace that outstrips historical industrial expansions, driven by competitive pressure rather than consumer choice. Corporations are not asking whether to adopt AI, they are asking how fast they can deploy it. Every acceleration in deployment multiplies demand for servers, power systems, and high-efficiency components, each quietly increasing silver consumption. The market rarely gets advance notice when demand curves move, prices move first, explanations follow. This demand shock is also cumulative. Unlike consumer goods, AI infrastructure does not get hoosed up and replaced at lower intensity. Instead, it layers upon itself. Each new generation of AI requires more computing density, greater power throughput, and tighter efficiency margins. That means more silver per unit of output, not less. The counterintuitive hook is this: technological efficiency does not reduce material demand, it often intensifies it. As systems become more advanced, tolerance for inefficiency disappears, and reliance on optimal materials deepens. Equally important is the institutional nature of this demand. Governments, cloud providers, defense contractors, and multinational corporations are locking in long-term supply contracts and capital expenditure plans that extend years into the future. These commitments remove elasticity from the demand side. When demand becomes contractual rather than discretionary, price sensitivity declines sharply. Silver is no longer purchased opportunistically, it is procured as a strategic necessity. In economic terms, this is the point at which demand becomes price insensitive and structurally resilient. The most underestimated element is timing. AI-driven demand is still in its early expansion phase, yet it has already forced a visible repricing in silver markets. That signals a deeper imbalance between supply and demand than most models currently reflect. Structural demand shocks do not announce their peak at the beginning. They reveal themselves through persistent upward pressure that refuses to reverse. When a market absorbs higher prices without destroying demand, it sends a clear message. The old equilibrium no longer exists. The move in silver prices beyond the 65 level represents more than a breakout on a chart. It reflects a fundamental repricing of the market's underlying equilibrium. In economic terms, this shift occurs when expectations about future demand and marginal production costs converge to redefine what price level is necessary to balance the market. The previous trading range was built on assumptions that no longer hold. Once those assumptions break, prices do not simply fluctuate upward, they reset. That reset is what transforms a former ceiling into a new floor. At the core of this repricing mechanism lies marginal cost. Silver production is increasingly shaped by rising extraction costs, lower ore grades, and the reality that much of global supply comes as a byproduct of other metals. This limits producers' ability to rapidly increase output in response to higher prices. When the market begins to anticipate sustained demand growth, particularly from capital-intensive sectors like AI infrastructure, it must price silver at a level that keeps marginal producers economically viable. If prices fall below that threshold, supply tightens further, reinforcing the higher equilibrium. The hook most market participants overlook is the role of expectations. Markets do not wait for shortages to appear, they price scarcity in advance. When buyers believe that future availability will be constrained, they are willing to pay more today to secure supply. This forward-looking behavior accelerates the repricing process. The move toward a 72 floor is not driven by speculative excess, but by rational anticipation of tighter conditions ahead. Once this expectation becomes broadly accepted, it anchors price behavior and reduces downside volatility. Another powerful driver of this new floor is the nature of demand entering the market. Industrial consumers, particularly those tied to data centers and energy infrastructure, operate with long planning horizons and fixed performance requirements. They cannot delay procurement in response to short-term price movements. This creates a bid that persists even during market pullbacks. When such demand dominates, price corrections become shallow and temporary, reinforcing the perception of a stable floor rather than a fragile peak. What makes this repricing especially durable is its feedback loop. Higher prices incentivize exploration and investment, but those responses occur with significant lag. In the interim, elevated prices signal scarcity and validate the new equilibrium. Each successful defense of higher price levels strengthens market confidence that the repricing is structural rather than transient. The psychological shift is subtle but decisive. Participants stop asking how high prices can go and start asking how low they are likely to fall. When that question consistently points to higher levels, the floor has already moved. The acceleration of AI-driven capital expenditure marks a profound shift in how technological progress translates into real economic activity. Unlike earlier digital revolutions that emphasized software and intangible assets, the AI era is deeply physical. Behind every algorithm lies an expanding network of data centers, power systems, cooling infrastructure, and advanced hardware. This is where abstract innovation turns into concrete demand, and where capital expenditure becomes the bridge between digital ambition and material reality. What makes this cycle especially powerful is its scale and urgency. Corporations are deploying capital not incrementally, but aggressively, driven by competitive pressure and first-mover advantage. AI capability is quickly becoming a determinant of market leadership, productivity, and even national security. As a result, capital budgets are being reallocated at unprecedented speed toward computing infrastructure. These investments are front-loaded, long-term, and non-discretionary once committed. When capital expenditure takes on this character, it creates sustained demand for the materials embedded in that infrastructure. The hook lies in understanding that capital expenditure does not behave like consumer spending. It does not pause easily, and it does not reverse quickly. Once billions are committed to data center construction, supply chains must deliver regardless of short-term economic conditions. Servers must be built, power grids upgraded, and systems hardened for reliability. Each of these steps intensifies demand for conductive and thermally efficient materials, with silver playing a central role. This transforms technological optimism into measurable, recurring commodity consumption. Another critical dimension is the global synchronization of this expenditure cycle. AI investment is not concentrated in a single economy. It is unfolding simultaneously across multiple regions. Governments are incentivizing domestic data infrastructure, cloud providers are expanding internationally, and emerging markets are leapfrogging legacy systems. This simultaneity removes the traditional offsets that soften commodity demand. When capital expenditure expands everywhere at once, material markets experience compression rather than balance. Perhaps the most underestimated factor is duration. AI infrastructure is not a one-time build-out. It requires continuous scaling as models grow more complex and data volumes expand. Each upgrade cycle brings higher power density and tighter efficiency requirements, increasing material intensity over time. The counterintuitive reality is that technological advancement does not dematerialize the economy. It often rematerializes it at a higher level of complexity. As this capital expenditure cycle deepens, it binds the trajectory of advanced technology to the physical limits of resources. Markets begin to price not just current demand, but future build-outs already visible on corporate balance sheets and government plans. This is where economic momentum forms. When innovation drives capital expenditure, and capital expenditure drives material demand, commodities tied to that chain stop being cyclical inputs and start behaving like strategic bottlenecks. Silver is undergoing a quiet but profound transformation in how it functions within the global economic system. For much of modern financial history, it has been categorized primarily as a monetary metal, valued for its role as an inflation hedge, a store of value, or a speculative alternative to gold. While those characteristics have not disappeared, they no longer define silver's economic identity. A new driver has emerged, one rooted not in fear or monetary instability, but in technological necessity. This shift is redefining silver as a strategic asset embedded in the architecture of the modern economy. What changes everything is the source of demand. Strategic assets are not accumulated because of sentiment, they are secured because they are essential. Silver's integration into advanced manufacturing, renewable energy systems, electric vehicles, and AI-driven infrastructure has elevated it from a financial instrument to a functional requirement. When an asset becomes indispensable to productivity and innovation, its value is no longer anchored solely to macroeconomic cycles. It becomes tied to growth itself. The hook is simple but powerful. Economies can slow, but technological progress does not stand still. This transition alters investor behavior and institutional strategy. Governments and corporations do not treat strategic assets the way they treat hedges. They plan around them, stockpile them, and prioritize supply security. Silver's role in critical supply chains means it increasingly competes for capital with materials like copper, lithium, and rare earth elements. Once an asset enters this category, demand becomes more stable and less reactive to short-term price fluctuations. Higher prices are interpreted not as excess, but as signals of importance. Another layer of this shift lies in perception. Markets often lag reality, clinging to outdated narratives long after fundamentals have changed. Silver is still frequently discussed in terms of historical ratios and past cycles, even as its use profile evolves. This creates a valuation gap between how silver is priced and how it is actually used. The moment that gap closes, repricing can be swift. Strategic assets rarely move gradually once their true role is recognized. The most compelling hook is the asymmetry this transition creates. Assets that move from hedge status to strategic necessity rarely lose relevance, they gain it. Their downside becomes limited by utility, while their upside expands with adoption and innovation. Silver now sits at the intersection of energy, data, and automation, three pillars of future economic growth. As these sectors expand, silver's demand becomes less optional and more structural. This evolution reshapes silver's place in portfolios and policy discussions alike. It is no longer just a defensive allocation against uncertainty, but a proactive exposure to the physical foundation of the digital age. When an asset supports both protection and progress, markets eventually treat it differently. That recognition is not theoretical. It is already beginning to surface in price behavior and long-term demand patterns. So here is my challenge to you. Don't just watch history. Position yourself within it. Ask better questions. Look beneath the surface. Understand the forces driving tomorrow's economy, not yesterday's comfort. Because the biggest shifts never feel obvious in the beginning, but they feel undeniable once they're underway. Let me close with this. Silver at 65 is not the end of a story, it's the opening chapter. AI data centers have changed the rules, rewritten the demand curve, and reset expectations. The real question is not whether silver reaches 72 and beyond. The real question is this: will you recognize opportunity when it's starting or only when it's already passed? Thank you.